Subramaniam Sharma, CEO and Managing Director of L&T Hydrocarbon and Engineering, joins us now. He's also the whole-time director and senior executive along with the vice president of L&T. Thank you for joining us. Have high oil prices automatically translated into higher business for you? Is the correlation one-to-one, and is it that quickly?
Yeah, actually the correlation is normally not that quick. I mean, it's not one-to-one and it's not that quick because I've been saying this, that most of the capital expenditure decisions are taken not so much based on a spot price, but keeping in mind an assessment of what the medium-term, long-term price levels are going to be. Having said that, I think higher prices and because of the current situation, geopolitical situation, as well as the demand supply situation does bring a positivity in the overall sentiment. And I expect that all the major oil companies will start formulating their strategy to expand more and spend more in capital in the years to come.
Do you see it becoming like a boom time for L&T's hydrocarbon business? Because I distinctly remember then when hydrocarbon business, I'm talking about oil and gas, when that cycle was in some kind of a downturn, it did impact your business. So are we looking at a very differentiated world for L&T, which is old hydrocarbon, oil and gas business comes back, and the hydrogen business which you're building up, that also becomes bigger? I mean, is it like a double engine for you now?
I wouldn't say that, a bit premature to sort of make those projections now, because we'll have to see. I think there's still some amount of uncertainty in overall pricing, at what levels it will settle, how the demand will pick up. Energy transitioning is happening globally, and what will be the sort of pace at which that will happen. So at this point in time, there are still quite a few, I think I would say, unknowns and uncertainties. But I think we have to take a sort of more pragmatic approach that is that this industry is cyclic. I mean, it has been cyclic since the inception. So that cyclicity ride will have to be prepared to take. And B is that, yes, I mean, since 2015, the oil and gas industry has always seen some, has been on the downside of the cycle for different reasons. And therefore, it has not received the amount of capital which it should have received. So if the demand remains and the transition doesn't happen too quickly, then I think there will be more investment coming in the conventional oil and gas, and that should sort of help us and also the others in the industry.
There is other problem, and we're talking about opportunity, high commodity prices. How much of your current business is an absolute pass-through? Because, sir, everything cannot be an 100% pass-through. And I'm sure given the commodity price surge, there will be an impact on the viability and the feasibility of existing projects also from existing buyers.
Yeah, I mean, I think that's, we all are hoping that this will be a kind of a temporary transient phase. And it should sort of normalize maybe in a few weeks' time. So again, I think making projections at a time when the market globally is very volatile and uncertain would not be appropriate. It has to settle down. I think the equilibrium will find its place. That's what normally happens in every aspect of life. So I think I believe that 4 to 6 weeks' time, maybe a new equilibrium will settle, and then we'll have to see at that point in time how it will impact and what will be the impact.
4 to 6 weeks, hopefully. But I wanted to, Mr. Sarma, talk a little bit about your business in the Middle East as well. How are you seeing orders pick up? Because internationally, you're predominantly situated in that region.
Yeah, we had some good run. I mean, last year we had announced, as you have seen, we announced in the press some large orders from Middle East. Middle East is our core market. And overall, we have been, for the last 3-4 years, our hydrocarbon business had a almost equal share of from the domestic and international market, and that sort of balance we want to maintain, and we believe that we'll be able to maintain in the coming years as well.
All right. Now, given the fact that fact, in the year 2021, we've seen the oil and gas industry saw capex cuts. There have been deferral of tendering of awards. There's been excess capacity as well that has been pursuing limited prospects. Competition as well has been on the rise. These are some of the concerns. How do you plan to deal with this, and have order wins been impacted severely on account of the same?
No, actually, as I said, I mean, we had some setbacks in the domestic, but we made it up internationally, and so I think that is where the benefit of having diversified portfolio comes in, and I think our effort would be always to keep looking inwards and see how we can focus on improving our overall execution performance, doing operational excellence, and create more value add proposition for the customer, and which will give us the competitiveness and also at least maintain our market share.
Okay, fair enough. So you're saying that as of now, you don't see the overall orders being impacted. What about the existing projects that you have at hand? Are you now going to be more aggressive with hydrocarbon orders? There have been recent ones as well that you've bagged, as you spoke of. But what are some of the order wins that are in the pipeline? Where do you see the overall order book position for hydrocarbon?
Well, I think, no, I don't know what you mean by aggressive, but once we take the job, our effort is always to execute it well, because in this business, having a satisfied customer is very important from a long-term sustainability. So all our efforts will be focused on delivering projects well and on time. And I think we'll keep looking for new opportunities. I don't want to put the numbers because we are in a very year-end closing stage, and we'll have the results announced maybe sometime in April, early May. I think we'll have to wait for the exact numbers until then. But I think it's business as usual so far.
We wish you all the very best going forward. Thank you so much, Mr. Sarma, for joining in and giving us a clearer picture as to how the hydrocarbon business is.
Gentlemen, great to have you both on the show, Jay as well as Nikunj. Nikunj, if I could start the discussion with you. Companies of late have been announcing price hikes, but in segments where demand is subdued because, such as in case of tractors or two-wheelers, do you feel the impact on demand will be more and companies may actually hold back announcing price hikes? Or do they have no option left but to hike prices given the kind of, raw material cost pressures that they as well are facing at their own end?
I think it's a very catch-22 situation for the automotive industry. And specifically the two segments that you mentioned, tractors and two-wheelers, there is already a subdued demand. Affordability is becoming a major criterion, specifically at the entry level. And I would say it's even impacting the entry level of cars. So while manufacturers would be tempted to pass on the price increase, but if they do, it's going to have a negative impact on demand, which is already subdued. So I think while looking at the bottom lines, they will also need to see the numbers that they want, and it'll be a tough balancing act for most manufacturers.
Jay, hi, Aisha here, and like Nikunj rightly pointed out, it is a bit of a catch-22 situation. But what happens at an earnings level? Do you see margins taking a hit for across-the-board Motan for the fourth quarter? Because different segments have sort of a varied lag effect, so I don't know whether you can paint the entire auto industry with the same brush. But given this tightrope walk that, the auto industry per se, whichever segment it may be it tractors, two-wheelers, CVs or passenger vehicles, are sort of facing, net-net, are we looking at margin squeeze here?
So yeah, on the raw material side, like you mentioned, I would just go back to Q3 and at the start of Q4, things were just easing off in terms of raw materials. They had stabilized. Companies had largely covered the cost increases. But then from Feb end, we saw raw material index moving up in the range of around 10-odd%, which is quite sharp. And to offset that, they will need another round of price increases, which, like Nikunj sir also mentioned, that is a little difficult in the current scenario. So what we are seeing, this cost increase that has come in from Feb and will obviously come with a lag of 3 to 6 months in the company's financials once they report, given their raw material contracts with the suppliers. But what this could do is our analysis suggests that around it could dent the EPS by around 10 to 25 odd % for most of the OEMs, given the incremental raw material pressure that we've seen. Now, that is assuming that they are not able to take any of the price increases because of this incremental pressure in FY23. While we believe that in the fag end of the year, they could take a staggered price increase, but definitely in the next couple of quarters, you could see this impact coming in because of raw materials, and that ranges between 10 to 25 odd %, different for different companies based on their fixed cost structure.
But just to build on this point a little more, Nikunj, and with that, I'll come to you. And that is, of course, prices will need to go up. Price hikes have to be undertaken simply because of, what's happening with commodity run-up, etc. But like Aisha was also pointing out, we have a problem with demand, right? Because of inflation and other things, plus the slowdown in the rural economy. Can the market absorb the price hike? How it'll impact the volumes? And what would be the best way around this?
I think to good specifically, we may still have waiting lists. We still have customers waiting for the vehicles. And some companies have reported a waiting list of over a year. So I guess except there where I see the price increase being passed on, some of the manufacturers have already talked about a price increase from 1st April. I don't think there is too much room in the other segments to pass on the price increase. But given the margin pressure and given the fact that we are at the end of the financial year, we might see some more price increase announcements coming in April.
Okay, so you're expecting price hikes in the month of April. So stand by for it. Of course, let's see what's also announced by the various companies with the earnings as well. Now, Jay, there are, of course, a lot of headwinds that have suddenly come up for the auto sector, right? When we talk about that. We've discussed it with the semiconductor shortage, prices of commodities going up, supply disruption. Toshiba has alerted that there might be even the semiconductor shortage going through this year because of the Ukrainian crisis. But Jay, what about particularly the two-wheeler space? Because there also we had seen a lot of degrowth.
Yeah, I mean, two-wheelers has been under extreme pressure. We are in FY19, we had done a peak volumes of around 21 million. In FY22, we will close around 13.7 to 14 odd million of volumes for the industry. So we are quite below the peak volumes. Of course, there has been approximately 35 to 40% kind of a price increase in the last 3 years to the consumer. So that has also dented demand. But going forward, I think, from on a low base with the rural kind of settling down and along with some bit of, boost of the EV segment, we are expecting a growth in FY23. Of course, but these assumptions, we were expecting close to a double-digit growth in FY23 on an extremely low base. But these assumptions were before this incremental crude price increase. So that will have some bit of a dent in terms of consumer sentiment, in terms of the cost of acquisition and cost of operations as well. There's a three-pronged impact on the two-wheeler and the entire auto sector. One is because of the raw material side impact of the EPS. Second is because of the unquantifiable impact on the demand situation because of the crude price increase. And third is the supply side issue because of the Ukrainian crisis and how supply chains get impacted. On the supply chain side, I think the two-wheelers are relatively lesser impacted because they need a lesser amount of chips and electronics content relative to, say, passenger vehicles. More so, in the entry-level two-wheelers will be lesser impacted. But I think there the question is about demand so much and not so much about supply. So I think from the three-pronged impact, two-wheelers are more impacted on the first two side of it, which is the raw materials as well as the impact because of on the demand because of the crude price increase. Not so much on the supply side issues for the two-wheelers.
Morning, Nikunj. Wanted to talk about flex fuel or flexible fuel, which is essentially an alternative fuel. It's a combination of gasoline and methanol or ethanol. And I wanted to get in your view because the government is very confident about companies getting the flex fuel engine soon to play. But how have you seen the progress on this front, and how are you looking at, the prospects of this being more promising for the industry as a whole?
So it's not going to be as easy as we think it is. And it's not because of the manufacturers not being ready. I think manufacturers will be ready with the flexi fuel engines. The compatibility will be there. I think the bigger problem lies with oil marketing companies. Having two kinds of fuel available at all dispensing stations is not going to be easy, because the older cars will need the unblended or the 10% blended fuel. They will not be able to take a 20% plus blended fuel, because they are not compatible to that kind of blending. So I think the challenge is going to be huge for the oil marketing companies, and the transition is not going to be as easy as we think it is. And also coming to demand, I think the fuel price increases that we are seeing day on, and I think this will keep on going further. This is also going to have a huge impact on the two-wheeler industry, specifically the entry-level two-wheeler industry. And I think we will all need to be braced with further degrowth at the entry level of two-wheelers.
You concur that, when it comes to flex fuel, while the government seems to be fairly confident, there is going to be quite a bit of trouble in actual execution. It's not going to be that easy.
Yeah, absolutely. I mean, like Nikunj sir mentioned that, on ground, how the fuel stations adopt, and how from the old vehicles versus the new vehicles, how the blending of fuel will impact the vehicles. The government has to be cognizant of the fact that, the old vehicles, either the fuel mileage or the parts issue should not come in because of the higher blending of ethanol. So I think these are teething issues which will come in once the flex fuel engine vehicles will be launched. How the OMCs manage between the new as well as the old vehicles. So that's something that will be keenly watched. But there is no doubt that most of the companies will be launching new vehicles with flex fuel engines, both on the two-wheelers as well as passenger vehicles. So we could see incremental launches from both two-wheeler companies as well as passenger vehicle companies in the coming fiscal.
We have with us Pramod Patwari, the CFO at Balrampur Chini, joining in on the show right now. Pramod, the last time that we were chatting with the sugar company, and they said, don't call us a sugar company, call us the energy sector. But that bullishness aside, just wanted to understand about the prospects of ethanol, considering Balrampur Chini derives almost 13% revenue from distillery business, and almost 10 crore litres of ethanol has been produced, as I understand, already in the 9 months of the fiscal. With the current push that you're getting from the government and the incentives, how big do you think the industry will be, say, in 5 to 6 years down the line?
See, it is very difficult to say where the industry would be 5 to 6 years down the line, because we need to understand that we are still dependent for our feedstock on the weather conditions. Particularly the state of UP this year, due to inclement weather, the cane availability is on a lower side. That is one part. But to answer your question, where the industry is heading, currently we are at around 8.5% of blending. Government has mandated 20% blending by 2025-26, and in the ongoing ethanol year, which begins from December, we are expecting a diversion to happen around blending to happen in the region of around 10%. And with the kind of announcement which we have been seeing from the government with regard to launching of flex fuel vehicles, next year definitely we are on the verge of attaining a higher blending.
Higher blending of around 10% is what you're expecting. But I also wanted to understand what the outlook is, because in FY22, OMCs had finalized tenders for about 385 crore litres, out of which about 353 crores had been contracted till date. So what is the growth outlook guidance looking like for entering into tenders with OMCs?
So for the ongoing season, the requirement for 10% blending is 459 crores. And as against that, around 416 crores has been offered. The contracted is around 385 crores, as rightly pointed out by you. We are looking at around 10% of blending this year in the season. So maybe around 400 crores of supply from the sugar industry, including the grain-based industry.
We were to get specific on Balrampur Chini, what is the update on your expansion program, Greenfield and Brownfield? And, what is the update as well on the distillery business?
As far as our expansion program is concerned, it is well on track. We are expecting to commence our distillery capacities around November 22. With the commencement of those distilleries, we will have the installed capacity available at around 35 crores, but this 35 crores will be available in FY24. For FY23, the available capacity, depending on the time of commencement of the new operations, will be around 23 crores. Within these 23 crores, we will use 2 crores to 2.5 crores for production of ENA, and rest we will dedicate towards production of ethanol.
Okay, fair enough. And I just wanted to get back actually to the sugar industry as a whole, given that we have seen globally prices rising as well, the currency has been weak. How are you looking at export opportunities for the sugar industry as a whole?
Yeah, as far as the exports in the current sugar season is concerned, we are expecting an all-time high export from India, minimum of 7.5 million ton, and we will not be surprised if it touches a level of around 8 million ton in the ongoing season. The value of Brazilian real as well as the ethanol parity is actually a tailwind at this point in time. So we are extremely bullish on the export from India.
And what about the pricing trends? How are you looking at that shaping up for your international markets, for the domestic markets? Do you believe that we can see global sugar prices continuing to rise because globally sugar is still in deficit?
Yeah, you are right. At the global level, we are still seeing a deficit of around 2 million ton, and the projections what we are hearing for the Brazilian production next year is at around 34 million tons. So there will be an opportunity to export from India. As far as the pricing trajectory is concerned, if crude continues to remain at the elevated level, this will be an additional tailwind as far as the international raw sugar prices are concerned. On the domestic front, this is going to be a very interesting sugar season in the history of the Indian sugar. We are going to witness an all-time high production, all-time high diversion of sugar into ethanol, best ever demand, as well as the highest ever exports. On the basis of all this, we are still expecting to draw maybe around 1 million ton minimum of inventory from the opening stock, which was around 8 million ton.
And give us a sense as to how realizations have been. What has been the average realizations? Have they been impacted given that costs have gone up?
Yeah, if we compare the current realization, which is around 34.5 on an average ex-factory in UP, which was around 32.5 for the full year FY21, you will definitely see that there is an increase in realization, but the costs has also gone up. Cane price in UP went up by 25 rupees per quintal. Availability of cane is on a lower side. Recoveries are on a lower side because of the inclement weather. So all these factors has really pushed up the cost side also.